Hello, welcome to Finance JCL. We're going to review Citigroup stock today, see whether it's a potential buy for our portfolios. Please note the usual disclaimer applies, not financial advice. Do your own research before you take any action. Got 5 key areas I review when I'm examining whether to buy an individual stock. First of these, which applies to Citigroup, is the chance of failure of this company high? Is the chance of failure? Now, Citigroup has a negative point here, which is a debt to equity ratio that's very high. Now, we're looking at 258%, and that is certainly higher than I'd like it to be. However, on the flip side, it doesn't look like this is a massive part of the balance sheet, and the dividend is certainly affordable. I'm looking at the payout ratio here over time, because that's a good check, and the payout ratio for the dividend is generally, well, it's always below 50%, and generally speaking, it's closer to the 30% mark. So the dividends are affordable. They're not risking a business in that sense. Now, arguably, this is above average US sector. Financial institutions in the American financial system, there is some history there. So I can understand why some people might stay away from it. The thing that gives me a little bit of confidence here is that Berkshire Hathaway or Warren Buffett, they are absolute experts on American financial institutions. They made some amazing purchases in the past with Bank of America and American Express. They own almost 3% of Citigroup. Gives me a bit of confidence that actually the chance of failure is probably quite low. So we then look at the quality of the company. Now, it's slightly different metrics from the standard metrics here, because for people like banks, insurance companies, return on capital employed, for example, doesn't really work. That's not how the finance works. But the operating profit, and I'm just looking across here by the screen, so the operating profit from operations, the 10-year average is 20%, and I've got a higher average actually for the last 5 years, getting towards 25%. So certainly this kind of company that's pretty high margins. Return on equity seems pretty good in the last 5 years, looking at between 7 and 11% each year. Importantly, the book value has been growing, and the book value is an important way of measuring the value of such companies. And that book value has grown around about 3.7% a year, it's getting on for 4% a year over the last 10 years on average. Remember that figure for later because we're going to need it. I'm looking at the other factors as well for the company. So the customer base isn't concentrated, so that's a good thing. But I do also already hold this sector, so I've got US Bancorp, and similar to an extent, although not exactly the same, I do have a banknote A. Also got American Express in the American financial sector. So I do have some similar companies. That is something to be aware of. I don't want to overfit money in the portfolio to a certain area. Other factors, they are doing a lot of share buybacks. And the share buybacks here, the average change in shares outstanding as a flat average over the last 10 years is almost 5% a year. Particularly the last few years, they've really concentrated on these buybacks. There are a lot more buybacks planned in the future. So in terms of earnings per share, that will generate notional earnings per share growth because shares outstanding for the same earnings will increase. Furthermore, there has been dividend growth, and even that, with the dividend growth, that payout ratio, the affordability of these payments is still pretty good. The dividend growth, if you go back, say 9 or 10 years, you're looking at 4 cents a share. That went up, and it's now $2.04 per share. So the dividend has grown significantly. Look at that as a percentage compared to the share price. You're looking at a yield of around about 4%. Okay, so it's looking quite interesting so far. We now move across to the valuation. This is where Citigroup really does look quite interesting. First of all, probably the negative side, the future growth is looking low. So analyst view on Yahoo and Simply Wall Street isn't suggesting any growth at all. That is disappointing. However, historically, they have grown the book value at almost 4% per year. So your best case scenario here is probably 4% per year growth. Dividend growth is possible as well, on the basis that the payout ratio is low. And if they continue to increase the value of the company through book value, that may help that point also. And talking about the book value, price to book is looking very attractive, the price to book ratio. It's a very good way to value these companies. So the sort of simple price to book ratio at the moment is 0.55. And in fact, that is one of the lowest values it's been for quite some time. So this is attractive. So in the very, very long term, the market value, generally speaking, you'd expect to sort of trend towards book value. The book value per share is 94.06. Price in the market at the moment is around about 51, 51.86 at the time of recording. So you can see there's a big discrepancy between values. So all in all, the estimated return by my calculation is in excess of 10% a year. And the reason for that is essentially, I'm looking, first of all, there's a dividend of 4%. Grow that book value by the historic value of almost 4% a year. You're looking at almost 8% a year. And that's before you factor in the fact that the book value versus the market price is showing big discrepancy, potentially in the investor's favour. We pull those together. My calculation is if we're looking at a current price over 10 years, we're probably looking at something like potentially 12.8% a year compound annual growth rate over 10 years. 5 years, that could be getting towards 20%. So to me, it does look attractive from a valuation perspective. So sum up, I think the chance of failure is on the lower side. This is a company that's been around for a few hundred years. The quality is good, although not necessarily exceptional. The book value growth of 4% a year, could that be higher? Other factors look pretty good in terms of dividend and buybacks. It's just a question for me around already holding a little bit in that sector. My holding US Bank Corp is only 1% of the portfolio, and their valuation looks very attractive. So therefore, in terms of the decision for my portfolio, this is purely based on my portfolio and circumstance. I'm not telling you to go and buy it, but I would love to hear in the comments below if you hold Citigroup, or if this is going to prompt you to perhaps have a look at them. What are your thoughts on that? It fits my portfolio structure, but it will fit into the dividend section. Dividend section of my portfolio, which is about a quarter of my portfolio, I'm looking to buy companies with good dividend yields, where they're affordable, but also where the valuation is very favourable. And therefore, there's a chance of some capital growth as well, which should push the return over 10% a year. I believe that is the case here for Citigroup. Buy more at the current market price of just under 52. It's 41. I'll add to that position. And my portfolio has a cash position of over 20%, I believe. Therefore, this feels like it's a good use of that cash. And it starts benefiting the dividends. And the ex-dividend date is early February. In fact, the ex-dividend date, if we have a look, I believe, 3rd of Feb. So if you're seeing this and you are interested in your own research, 3rd of Feb is that ex-dividend date. So you need to get in there to get the next dividend payment. So I think that's everything that I've got on my checklist. If you are looking for another company portfolio and you want a high quality company, check out the video linked on screen now. You don't want to miss it. It could be an interesting buy for your stock portfolio.